Payal and I am from the Management Study Guides content team. In this program, we are going to learn about Introduction to Stocks and Investing. Peter Looney works as an executive. For a long time, Peter has felt that he should invest the extra amount of money that he makes from his job. He has been saving in cash form for a long time. However, he wants that he should use the saved amount to invest in something that could help him multiply his money and help grow his finances. Peter has always thought of starting a business venture to grow his money. However, he is greatly averse to the huge amount of risk involved in any business venture. So, Peter starts asking advice from his colleagues about what possible investment options are available in the market. George, one of Peter's colleagues, advises him to invest in stocks and mutual funds. Stocks are the capital raised by a corporation through the issue of shares entitling holders to an ownership interest, also known as equity. Mutual funds are an investment vehicle made of pool of funds collected through a regulated investment company from many investors. This pooled money is then used for the purpose of investing in securities such as stocks, bonds, money market instruments, and similar assets. Money managers operate the mutual funds by investing the fund's capital and attempt to produce capital gains and income for the fund's investors. George tells Peter that by investing in stocks and mutual funds, Peter can earn a small share of the great profits that big and successful organizations make for themselves and their shareholders. George tells him that although Peter will get to enjoy a part of the profit made by the organization, he will be spared of the hassles of running a business on his own and also will undertake a much lesser risk than if he would have to run a business on his own. Therefore, although stocks and mutual funds would help Peter to multiply and grow his money, he would be able to do so by taking advantage of the stability and experience of these fast-growing and stable organizations that have been operating and making profits for decades. George also adds a word of warning for Peter. He tells Peter that the most important thing that he should keep in mind while investing in stocks and mutual funds is that he should determine the maximum risk that he is willing to take. Peter should always make sure that he never invests more than his risk-taking capacity. George assures Peter that if he takes calculated risks and invests wisely, then stocks and mutual funds prove to be a very lucrative way of growing his money. Therefore, you can understand that investing in stocks and mutual funds are a great way to multiply and grow your money by undertaking calculated amount of risk according to one's own risk-taking capacity. So, let us now learn about stocks and investing in detail. Before we begin the program, let's take a look at some of the objectives that we will be covering in this program. Introduction to Stocks and Investing will explain to you what is the meaning of stock and what are the types of stocks. It will also give you a classification of common stock. It will help you understand and describe the role of beta in your portfolio. Through this program, you will be able to list the various stock screening criteria. You will also be able to understand the types of analysis in stock trading. This program will explain the ratios for valuing firms. It will help you list the criteria for choosing a broker. This program will also explain the common stock investing strategies and the steps of a typical stock transaction. You will also be able to understand how to read stock quotations. You will be able to understand the calculation of price to earnings ratio. In this program, we will be able to learn the key terms of stocks and investments. This program will help you describe the rights of a stockholder and the various investment options. So, let's begin. So, what do you think is a stock? Let me tell you. Any business needs money or capital whenever it has to start its operations or expand its business operations. Thus, in order to raise this capital for a business startup or expansion, the corporation would offer shares of stock for sale to the public. Growth stocks is a stock that compensates investors primarily through increase in value of the shares over time. These are issued by companies which are growing faster than average and which generally reinvest dividends. Also, they generally have higher PE and PB ratios than the market as a whole. A reverse split is the opposite of a stock split. A reverse split is carried out by a company if the company's stock price is too low. So a company may do a reverse split to reduce the number of shares outstanding and raises the stock price. What is fundamental analysis? The chief assumption on which fundamental analysis is carried out is that the value of the stock can be determined based on the future earnings of the company. Financial analysts carry out thorough research on the background and operations of a company, the state of the industry to which the company belongs, and the global economy, etc. The following are the steps that we can follow in any typical stock transaction. The first step is placing of buy or sell order. Step number 2 is relaying of information. Step number 3 is reaching the specialist. Step number 4, matching of buy and sell order. And step number 5, transfer of stocks and money. Let's take a look at each of these steps in detail and understand them better. The stock's price earnings ratio, also known as PE, is shown in almost all stock quotations. PE ratio represents the company's prevailing stock price per share divided by the firm's earning per share. The PE ratio is usually closely monitored by many investors. It is believed that a low PE ratio relative to other companies in the same industry shows that the prevailing stock price is too low based on its earnings. Therefore, such a stock may be perceived as undervalued and considered a good buy. Next, return on equity, also known as ROE. The return on equity is defined as a ratio of the company's earnings per share divided by the company's book value per share. Thus, ROS measures how well the company is utilizing the assets of the company to make money. Here are a few of the generic rights of a stockholder: voting rights, limited liability, stock splits, preemptive rights, claim on income. Let's take a look at each of these in detail now.